There's a fundamental lie at the core of how most people interact with the cryptocurrency market today. If you are looking at your trading terminal right now, watching the green and red candles flicker up and down, you are not looking at the market. You are looking at a shadow on the wall. In the world of institutional finance, price is a lagging indicator. It is the final result of 1,000 decisions that have already been made in the dark. For the retail trader, the chart is the only reality. But for the smart money, the entities moving billions in capital, the chart is merely a playground where they engineer liquidity to fill their own orders. We are currently witnessing one of the most sophisticated divergences in recent history. On the surface, the market appears to be in a state of volatile consolidation, perhaps even gearing up for a breakdown based on traditional technical analysis. Fear, uncertainty, and doubt are dominating the social sentiment. But if you peel back the layer of price action and descend into the raw data of the blockchain, the narrative shifts violently. Today, at Crypto XRay Labs, we are not here to speculate on tweets or to analyze subjective patterns drawn on a chart. We are here to follow the immutable trail of money. We have detected a critical anomaly, a massive disconnect between what the price is doing and what the largest holders are actually doing. This is what we call the accumulation divergence trap. Understanding this concept is the single most important factor in separating your portfolio from the 90% of traders who consistently lose money in this cycle. The market is designed to transfer wealth from the impatient to the prepared. It feeds on the emotional reactions of those who trade without data. When you see a sudden drop in price, your instinct is fear. When you see a spike, your instinct is greed. Smart money knows this. They use algorithms to trigger these emotional responses, forcing you to sell at the bottom and buy at the top. But the blockchain does not lie. Every transaction, every wallet movement, every transfer from a hot wallet to cold storage is recorded forever. This data is the truth underneath the price. In this report, we will visualize exactly how institutional players are currently absorbing the selling pressure from retail panic. We will show you why the current price action is a fabrication designed to shake out weak hands before a major structural move. We are entering a phase of the market where traditional technical analysis tools, RSI, MACD, moving averages, are failing to predict direction because they do not account for off-chain capital flows. You are trading blindfolded if you ignore the on-chain reality. The data we are about to reveal suggests that while the crowd is looking left, the money is moving right. This is the edge that professional traders use to survive bear markets and explode during bull runs. Welcome to the deep end of the data pool. Let the analysis begin. Let's get specific. To understand the divergence, we need to look at 3 distinct data sets: exchange net flow, mean dollar invested age, and miner outflows. We pulled this data using the Radar XRay aggregation engine, which allows us to filter out the noise of microtransactions and focus entirely on smart money movements, defined here as transactions exceeding $100,000 in value. Look at the screen. The top chart shows the Bitcoin price action over the last 30 days. You see the volatility, the sharp drops, and the weak recoveries. Now, overlay the second chart. Exchange net flow. The correlation is terrifyingly clear for those who know how to read it. Standard logic suggests that when price drops, people are selling. Therefore, we should see coins moving into exchanges to be sold. For the first 2 weeks of this month, that is exactly what happened. Retail panic selling was high. However, look closely at the data from the last 72 hours. The price has continued to dip, creating lower lows, but the exchange net flow has turned sharply negative. This means that despite the price dropping, coins are flowing out of exchanges. Who is moving coins off exchanges when the price is plummeting? Not the retail trader. Retail traders keep coins on exchanges to sell at a moment's notice. Moving assets to cold storage involves gas fees and time. It is a long-term commitment. This outflow represents a transfer of wealth from weak hands to strong hands. This is the definition of accumulation. The Radar XRay tool allows us to tag these specific wallet addresses. We can see that a significant portion of these outflows is going to wallets that have a history of accumulation. They have not sold a single coin in the previous cycle. This is the hodler behavior that typically precedes a supply shock. When supply moves to cold storage, the circulating supply available on exchanges decreases. As demand hits this reduced supply, the reaction is mathematically explosive. But we must also look at the third metric, mean dollar invested age. This metric measures the average age of all coins currently being moved. If the age is low, it means new coins are moving, panic selling. If the age is high, it means old coins are moving, ancient whales waking up. Currently, we are seeing a mixed signal. Old whale wallets are distributing, but new institutional accumulation wallets are absorbing those coins even faster. This creates a battle of the flows. The whales are selling their old bags at a profit into the panic, while smart institutions are buying the dip. The price stagnation you see is the equilibrium point between these two massive forces. However, the momentum is shifting. The volume of accumulation is beginning to outpace the volume of distribution. Once the distribution from the old whales dries up, the wall of sell orders vanishes, and the institutional buy pressure will push the price up violently. This is why price action is lying to you right now. It shows you a battle where there is actually a slaughter. One side is running out of ammo while the other is rearming. Trading without seeing this flow is like trying to navigate a minefield in the dark. You might make it a few steps, but eventually the odds will catch up with you. Knowing the data is only half the battle. The other half, and arguably the more difficult part, is executing a strategy that respects this information without exposing yourself to ruinous risk. We must be brutally clear here. Seeing accumulation does not mean the price cannot go lower. In fact, markets often push down to their absolute liquidity limits to trigger the final cascade of stop losses before the reversal. Smart money knows where your stops are. They can see the liquidity pools. They will hunt them. If you go all in on leverage, just because you see a negative net flow, you are gambling, not trading. The true professional edge lies in patience and position sizing. How do we apply this? We do not predict the absolute bottom. Instead, we wait for confirmation. We use the Radar XRay data to identify zones of high institutional interest. Once price enters these zones and we confirm that outflows are accelerating, we begin a dollar cost averaging DCA strategy. We accumulate slowly. If the price drops further, we buy more, knowing that the on-chain data supports the long-term thesis. But we never over-leverage. We preserve our ability to survive the volatility. This is how you trade alongside the giants, not against them. You adopt their timeline. Institutions do not care about daily candles. They care about quarterly and yearly positions. They're playing 4D chess while retail is playing checkers. By shifting your mindset to data-driven accumulation, you remove the emotional component. You stop worrying about the daily fluctuations because you understand the macro flow. This approach requires discipline. It requires logging into your platform, checking the flows, and sticking to the plan even when the news headlines are screaming about a crash. It requires ignoring the influencers who promise 100x returns in a week and focusing on the boring, repetitive reality of blockchain data. At XRay Labs, our mission is to democratize this data. Previously, only hedge funds had access to these kinds of visualizations and flow analytics. Now, the playing field is leveling, but tools are useless without the operator. You must take this concept, the divergence between price and smart money flows, and apply it rigorously to your own portfolio management. Remember, nothing in this video constitutes financial advice. We are analysts, not advisors. We show you the map, but you must drive the car. The market rewards those who do the work and punishes those who follow the herd. As we move forward into this next phase of the market cycle, the gap between the informed and the uninformed will widen. Ensure you are on the right side of that gap. Keep watching the flows, manage your risk, and trade with logic, not fear. The data is waiting for those who know how to read it. This is XRay Labs. Stay safe, stay analytical.